This afternoon's number is 3.8 million. The U.S. is 3.8 million single-family homes short of buyer demand. That's according to Freddie Mac, the mortgage finance company. Even before the pandemic, demand exceeded supply. In 2018, Freddie Mac estimated a supply shortage of about 2.5 million homes. But it's unusual that in a recession, housing demand declines. And Freddie Mac says that it's mainly due to a long-term decline in the number of single-family homes being built. Usually during a recession, that supply goes up. Well, joining me now is Pierre Debbas. He's a partner and founding member of Romer Debbas, LLP. Pierre, great to have you back on QuickTake. Thanks so much for being here. Look, signs indicate right now that we could be headed toward a housing bubble. Is that what you think?
You know, it's a very interesting question because you started off the conversation with stats that would lead conventional wisdom to think that if entering the pandemic, it would have resulted in a housing crisis, not historic demand and price appreciation for housing across the country. So now when you look at the factors, when we talk about a potential housing bubble, it's very hard to pinpoint a specific reason what will prompt this to be a bubble. Really what's causing the speculation, from my perspective and, several real estate professionals in the industry, is just the rapid price appreciation and demand and pandemonium that's really entered the housing market throughout the entire country. I mean, Tim, we emailed about the statistics on the housing market, this week about a 16%, price appreciation year over year from, now from April 2020. And then we're also talking about the median home price breaking $300,000 for the first time in the country's history. Demand and activity has been incredible. And how long will it last? And, we both know the, National Realtors Association Realtor stat of this being a 15-year high. So when you take all those stats, we think, okay, we're entering a housing bubble. And, if there is to be a bubble a year from now or not, hindsight, we'll look back at hindsight and say, okay, yeah, we should have known that was a factor for the bubble. So again, it's very difficult to pinpoint precisely what will cause it to be a bubble. But, just given everything that's going on, it feels like we are going in that direction.
So what is the reason why, apart from, I wonder about what the cause is, right? Freddie Mac says that a lot of it has to do with the long-term decline that we've seen in home builders building, and they're just not constructing fast enough. But doesn't that show you that the market isn't necessarily working? Because if demand is so high, then these homes should be being built because they're going to be sold.
Yeah, you'd think more supply would be entering the marketplace.
Right.
And, when you go back to the financial crisis in 2008, one of the results of that was that credit was tightened significantly, and there was a glut of inventory of single-family houses throughout the country, which had led to a trend of a significant reduction in development in that asset class. But here we're talking 13 years post-financial crisis. You'd think that the development would have picked up to meet current demand levels. So, from that perspective, what could drive pricing down or cause it, have a detrimental impact on the market? I honestly think it's going to be that, millennials, first-time home buyers in the middle class are going to be priced out of the market. And if they're priced out of the market, then, demand has to decline significantly, and also factor in two other things. Interest rates are rising, at a, marginally, but, they're on the rise, and the potential of inflation. When those things all come into play at the same time, I think that's really where you're going to see, certainly a correction in the housing market. Maybe a bubble, maybe not, but definitely a result in a correction.
What does this mean for millennials, right, and Gen Z? Because I saw this tweet the other day that just talked about how being born in the 80s or 90s economically has been pretty tough on a lot of people. College keeps going up in price every single year. We see the collapse of the financial system in 2007, 2008, 2009. A lot of people graduated into the recession. And now we're at a point where homes have gotten so expensive that many people can't even imagine themselves actually buying a home.
Yeah, I mean, that was my point earlier, that I think that a certain segment of the market is going to get priced out.
But permanently?
I think once a correction takes place, as long as interest rates don't spike significantly and lending, the quality of lending maintains current levels, I think we'll be fine. The one distinct difference between, today's market and 2008 financial crisis is the quality of lending. Back then it was driven by subprime lending, everybody qualified for a mortgage. Credit was way too loose in the marketplace. And today, credit, banks are underwriting at a very healthy level. They're being extremely diligent. We're not worried about, any reckless, lending activity like we were 13 years ago. So as long as, the millennial generation has access to credit in the way that exists today, and rates don't jump up significantly, they should be able to re-enter the marketplace, once a pricing correction takes place.
Do you see the rise of remote or hybrid work helping to change this narrative a little bit? The idea that people don't necessarily have to live in these handful of super cities in the United States to get great jobs, and they can go to places in the Midwest, for example, where the cost of housing isn't as high?
I'll tell you, both from a perspective of a business owner and a real estate professional, that I think is probably arguably one of the top three biggest factors for why we've seen such a significant rise in the housing market in the past year. The way we live and operate is completely, I personally think, going to be changed forever as a result of this. And the millennial and Gen Zs were already talking about a hybrid or working from home structure before the pandemic. And now here you are, I just read a stat today that they expect 50% of the workforce to be back in New York City in September. So you're talking a year and a half of living like this. The workforce has demonstrated they can function under these parameters. And that resulted in people saying, why pay the high cost of living in New York City type place, or any major city for that matter, and go live in a more, remote, less densely populated area at a fraction of the cost, but maintain my income that comes from a major city. And I don't think that's going to stop. I mean, I interviewed, to tell you my small business owner perspective, I have a couple of paralegal positions I'm trying to fill. And a few people applied for jobs saying, as long as you're okay with me, I just moved outside of Philadelphia for a lower cost of living. As long as I can be remote fully, I'm more than happy to interview for the job. Yeah. And I'm sitting here, I'm like, I got to see you at least once. At some point, there'll be some requirement for human interaction. So it will be very interesting to see, I think we're not going to know for a year from now in terms of, what percentage of the workforce can be virtual forever and take advantage of this trend that you and I just discussed.
Pierre Debbas, managing partner at Romer Debbas LLP. Pierre, always great to have you on the show. Thanks so much for taking the time. Appreciate it.
Great to see you.
Well, coming up, some